Are you tired of guessing your way through the markets? Today we are diving into the world of chart patterns, indicators and strategies that can help you make more informed trading decisions. Sharpen your skills, gain a competitive advantage, and let's take your trading to the next level. Technical analysis is one of the key pillars of trading success. We have trading psychology, we have technical analysis, and we have risk management. Without technical analysis, you basically cannot do anything because you need it to properly analyze and predict where the markets will go. Day trading is based on planning, on analyzing the markets, and then predicting where the market will go. If you are not good at technical analysis, you will not be able to trade properly and you will not be able to make money in the financial market. Technical analysis is like a superpower that lets you to predict the future and predict where any financial market will go. But it's not as simple as it looks. You have to understand it, you have to understand how to do it properly, and only then you can properly analyze the markets and predict where the markets will go. Professional traders are able to consistently extract money from the financial markets because they have a thing called technical edge. A technical edge is the ability to analyze the markets better, to understand the markets better than all the other traders, and that enables them to get ahead of the competition and to consistently extract money from the financial markets. So the first thing that you should understand if you want to do technical analysis is that you have to analyze markets on different time frames. It's not enough to just open 1 hour time frame, do your analysis and make your decisions, because that decisions may be wrong because you're not looking at the bigger market picture. Maybe on 1 hour you are seeing that the market is going upwards and then you want to open buy positions, but in reality if you zoom out a little bit, you are seeing that the general market trend is downwards, it's bearish, and you will open your buy position and you will get stopped out. So what you should use is a top-down approach. When you are starting to analyze the markets on bigger time frames like daily or 4 hour time frames, so the purpose of that is to first of all get a great idea of the general direction of the market. What is the major trend of the market? Is it bullish? Is it bearish? Where are all the key market levels? Where are all the psychological levels and all the important levels in the markets that are holding the market on 4 hour time frame or daily time frame? Analyze these big important things, and only then you can scale to lower time frames. So then you can move to 1 hour time frame, and then again think about the trend, look at the candlesticks, look at support and resistance levels, and on 1 hour time frame, depending on which style of trader you are, you can then start to make decisions of where to enter into the markets. Or if you are a scalper, move to 1 hour, analyze the markets, and then move to 15 minutes where you can analyze the markets even further. You can look for the best entry and all of these things. So the way I do technical analysis is, first of all and most importantly, I analyze the market structure. Market structure is what lets you to understand the direction of the market, the way it moves, where are all the impulses and retracements. I go to daily or 4 hour time frames and I analyze the market structure. Is the market currently in the impulse or in the retracement? Is the market currently going downwards or upwards? And then, for example, if the market is in the retracement and I know that the major trend is downwards, only then I get the bias that the market will go downward. And if the market trend is bullish and we can see that the market made an impulse, now it is making a retracement, then I get an idea that I have to look for a buy position. Market structure is the fundamental movement of the price, so it's really important to first of all master market structure if you want to be a good technical analyst. Then you can look at support and resistance levels. Where are the support levels? Where are all the resistance levels? Then you can use indicators. Look at the indicators. What information do they provide you? What they are telling you about the volume? What are they telling you about the moving average of the market? Then you can look at candlesticks. Do you see any candlestick patterns? What the candlesticks are telling you? Are they indicating a bullish movement? Are they indicating a bearish movement? And try to combine all of these things together. So usually I do the market structure analysis on bigger time frames like 4 hour or daily, Then I go to lower 2 hours or 1 hour time frames. There I look at the indicators, I look at the structure, I look at the candlesticks, and I look at support and resistance levels. Try to take into account everything, all information that you can possibly acquire, and try to put it into one plan to trade. So now that you know how to analyze the markets, what are the steps, you should know the best trading philosophy that you should use in technical analysis in order to be a successful, profitable day trader. So the first thing that you should understand and the approach that you should have in day trading is that you have to plan and execute. So it does not mean that you come into the markets and you are making some random decisions, you are pressing the buttons of buy and sell, you are closing positions, and then you will just be losing money. But in day trading, you have to do your analysis firstly, and then you have to plan the trade. So you consider every tool that you have, market structure, indicators, or whatever you're using, you consult with it, and then you make a prediction of where the market will go. Think about your stop loss, your take profit in advance before opening the trade. Think about your exit strategy, when you will move your stop loss to break even, or whether you will move it at all, when you will exit. Think about your take profits. So you plan the trade, you look at all your tools, you devise the best strategy, you plan the trade, and then you execute when the time comes. In this workflow, you will work as a professional day trader. You will not be a gambler, or you will not be a person who is just doing some dumb decisions in the markets. You will be planning and executing the trade. Also, remember that it is best to stick to only one strategy. Don't change your strategy every week. Try to develop a one perfect strategy that is comfortable to you, and then try to apply that strategy over time. Try to improve it as much as you can, and then using that strategy, plan the trades and then execute. So that's it for this episode. Hope you guys enjoyed it. If you found this informative, leave that like button, subscribe, and see you in the next one.